Hello and welcome. This is Kathleen Levito, and I'll be your host for today's webinar entitled Planning for Life Insurance, Protecting Your Family's Financial Future. Joining me today is Natalie Bach, Member Benefits Representative, and Carlos Perez, Chief Operating Officer at AAFMAA. They will be sharing just about 30 minutes of slides for you today. We will conclude this presentation with a question-and-answer series, so if you have any questions during the presentation, please feel free to enter them into the question bar on the screen. AAFMAA stands for American Armed Forces Mutual Aid Association, as the longest-standing not-for-profit association that empowers military families with affordable financial solutions. AAFMAA focuses exclusively on the needs of the military family and works to provide innovative, personalized, and lifestyle-appropriate financial solutions. We accomplish this by being the premier provider of affordable life insurance, expert investment management, customized residential mortgages, and exclusive survivor assistance services, all for the military community, not for profit. This presentation is educational. It is for general information only and is not specific investment, legal, or tax advice for any of you individually. Do not rely on this presentation alone to guide your life insurance decisions. Since each individual situation is unique, the life insurance that benefits you the most will not necessarily be the same as another current or former service member. For individual advice, please contact us directly. We produce this webinar series in-house with our own professional staff as a service to our members. I'll now go ahead and turn it over to Natalie to begin the presentation.
All right. Well, thank you so much, Kathleen, and I want to welcome all of our members and potential members to our webinar. Today we're going to have a conversation about planning for life insurance. So basically, we have an expert here. Carlos, thank you and welcome. I'm going to ask you a couple of questions that our members ask us. First of all, who needs life insurance, and how does life insurance affect my family's financial plan?
Great. Well, let me begin, first of all, by thanking all the members and others that have joined us in our webinar today. We're glad that you could be with us for a really important topic, and that is understanding how to plan for life insurance, especially recognizing that it changes over time. And these are great questions that you've asked, Natalie. So what I thought we'd do today through conversation is walk people through this decision-making to see what they might need at different points in their life. But before we do that, and before I answer your question, I want to take a step back and look at something a little bit more broadly, and that is talk about this concept of financial independence or financial security. At AAFMAA, we present this model as a three-legged stool with components that include budgeting, saving and investing, and protecting. And so you see there highlighted in red that protecting leg, that's where life insurance falls in. And it's this idea that over life, as we budget and save and invest and work hard, we want to protect those assets that we accumulated. And we do that through insurance. Here at AAFMAA, we provide life insurance, but there are also other types of insurance like homeowners insurance and renters insurance and auto insurance, which we don't provide, by the way, but they are an important part of protecting. And so within that context, then, we'll dive into this life insurance specifically today and talk about who needs it and how it affects the plan. And so here are the basics, and I'll just start out by pointing out that life insurance really isn't about you. It's not about you, the member that's listening out there today. It's about your loved ones and about your survivors. And so when somebody asks me, should I get life insurance or do I need it, I always answer with a question, and that is, does somebody else depend upon you for income? Because that's really what it comes down to with life insurance. It's if somebody depends upon you for income, then you are a strong candidate for life insurance. And we've shown on this slide a couple of reasons that people purchase them, and we'll talk about these in more detail as we go through our discussion today. We'll also talk about the basic types of life insurance. But most importantly, what I would like people to take away today is that needs change over time, and we should periodically assess those needs and adjust our plan accordingly, just like we do with other things in life. And that's the key takeaway is you have to do that, and you have to recognize that what you have today may not be best for you 10, 15, 50 years down the road.
Okay. So, Carlos, we consistently have members ask us, what is the best life insurance for me? And the answer, we know, really depends on your life circumstances at the time. So for today's webinar, what I thought would be helpful for our members is to go over scenarios based on the different life phases inspired by some of our AAFMAA members, basically chronologically, okay? So the first scenario is a 22-year-old junior service member, unmarried, who already has $400,000 of SGLI.
Yeah, I love this idea of walking through a timeline, and so let's dive in. And so this question is about somebody starting off, and we have a great image here of some young officers taking an oath, probably an oath of service, and so these are people at the beginning of their career, and when you join the service, you have a great benefit called Service Members Group Life Insurance provided to you, SGLI, which provides about $400,000 of coverage, which you've mentioned. And so for this demographic that is just starting out, that coverage may be about right. It may be enough, especially if they're single and they don't have a large number of dependents that rely upon them. But what's important for this group, and the takeaway here is that if you're not sure whether you're going to stay in the service, you will lose SGLI when you separate. And so if you have a need for insurance and want coverage, you have to replace SGLI, or at a minimum, you have to plan for replacing SGLI. Number two, the other thing is that SGLI is pure term insurance, and I'll explain what that is here in just a little bit. And it really has no other benefits, unlike other companies that may have other benefits tied to life insurance policies. So the example I'll use with AAFMAA is that every life insurance policy with AAFMAA includes survivor assistance services. So if a member or a policy owner passes away, an AAFMAA survivor assistance representative will be assigned to them, and will work with them individually to help them file not only their life insurance claim with AAFMAA, but we'll also be happy to help with any other life insurance companies that they might have, and we'll also help them file for any other benefits that they may have earned through their service, for example, VA benefits. So not all life insurance policies are the same, and even though SGLI is a relatively good deal, you may want to consider other options to SGLI because there may be other benefits tied to it.
Makes sense. And I can't tell you how many heartfelt thank yous I've heard about survivor assistance. Okay, so we're moving along our timeline. Now I'm a 29-year-old Army captain. I just got married. My spouse and I just put a down payment on a house. What do I need now?
Well, so here is a service member who is now progressing in life stages, and it's a great time. You see a happy couple here who just bought their first house, as you mentioned. So what we see with this demographic is that you are starting to potentially accumulate some large ticket items. A house, a mortgage on a house can be, hundreds of thousands of dollars. And so now you have your SGLI coverage, but you may actually be underinsured. And so this person is a candidate for potentially additional coverage, maybe not substitute coverage, but additional coverage to help them meet any shortfalls. A recent study in the life insurance industry found that just under half of American households actually have an insurance gap. That is, that if the person were to pass away, the life insurance that they have in the household is not enough to cover some of these large expenses. So in this particular example, this person ought to think about that mortgage, since they just bought a house, and ask themselves, if they passed away, would their SGLI cover the outstanding mortgage and any other expenses that are out there and provide income for the survivor? If the answer is no, then they should consider additional policies or additional coverage. And so the next question is, well, what type is best? And I referred earlier to term life insurance. So I want to pause here a second and explain that. Term life insurance is a policy that you can take out for a known period of time. It can be 20 years. It can be until a certain age. It can even be, in this example, for the duration of your mortgage. And what these policies provide is a relatively large amount of coverage. So here you see death benefits from $50,000 to $1 million, at a relatively low premium. So you get the most coverage for the least cost with these types of policies. And they make great sense for that junior service member who is just getting started, as you said, newly commissioned or just got married and bought a house. We often see this as a great solution for their insurance requirements.
All right. Well, so now we're getting older and life gets more stressful. Now I'm 38 years old, just had my third child. We own the home we live in and a rental property, meaning we have 2 mortgages, and my spouse stays home with our kids.
Yeah. So this is a person who really now is looking at protecting more than just potentially himself and a loved one because of a growing family. So some of the stuff that we've already discussed will continue to apply. So in this case, this person is probably still a candidate for some type of a term policy to potentially replace SGLI or cover gaps. In this case, not only is there a home in the picture, but there is also a mortgage burden and, additional children in the picture. And so here I have a mortgage and I have college expenses to pay for, and college is very costly today, as our audience probably knows. So again, a great candidate for term. But what I wanted to point out in this particular example is the children. There's a lot of discussion about whether a child should have a life insurance policy. And in fact, earlier I mentioned that the main criteria for life insurance is if somebody depends upon you for income. And most people would argue that, I don't depend upon my child for income. They don't generate income. But there are some good reasons, and there is an exception to every rule. And in this case, there are exceptions to why you may want to consider a policy on the child. And I'll offer up 3 reasons. One is if that child were to pass away, there are still the death expenses, the final expenses. And when you look at the costs of a funeral today, a casket today, and paying those expenses, they can add up anywhere from $10,000 to $40,000 or more. So it's not an insignificant amount of money for a parent to have to come up with if a child passed away. Secondly, because children are young, they are relatively healthier, and so their premiums are lower and they are, in a sense, more insurable. So one of the things you can do for a child is you can lock in life insurance for them while those premiums are low and while they're very healthy. And then lastly, in some cases, that insurance may provide them eligibility for other benefits down the line. And I'll use AAFMAA as an example, but I'm sure other companies have similar types of examples. With AAFMAA, we only provide insurance to service members and veterans and their dependents as defined by the DoD. So if a child ages out of the category of dependent as recognized by the DoD, they would not be eligible for an AAFMAA service unless they were in their own right, unless they joined the military and became a veteran themselves, unless they have an existing AAFMAA policy. So if you were to buy a child policy for AAFMAA, as long as that policy remained active, even if the child aged above dependency age, they would remain eligible for any other product that AAFMAA provides, not just life insurance, but mortgages, financial planning, investment management, trust services, survivor assistance, everything. In the example that we have here in AAFMAA, we have what we call a Generations Plus policy, a great policy for a child. You can buy coverage from $10,000 to $50,000. At age 18, the coverage doubles, and they have 4 opportunities between ages 21 to 41 to buy additional coverage guaranteed without additional underwriting. So that is a tremendous benefit that goes well beyond childhood that a son or daughter can take with them for life.
Absolutely. It sounds like that would make it a really good gift.
It could. In fact, we have members that gift those policies to children and grandchildren.
Nice. Okay. So we're moving along. Now I'm 45 years old, getting ready to retire from the military. I have a job lined up as a contractor once I get out, so I'll be starting my second career. And my spouse will be working full-time too, now that the kids are older. Should we both get life insurance?
Yeah, that's a great question. And so before I answer it, I do want to just make a couple of points with this particular person. Having been through a military retirement myself, this is a time of great transition. There's a lot going on in the family at this stage in life. And so just with as we did with our prior candidates, this person needs to keep in mind how he or she may replace SGLI if they still need that type of large coverage. Some of these service members will find employment with a company that offers life insurance as a benefit of employment. What I would caution our audience out there is that many of these policies are only valid while you are employed with that company. So if you think you need that additional coverage beyond what you expect, the time you expect to spend with that company, that may not be a sure thing, so you should check it out. Now, this person is also at a stage in life where they are probably lowering their burdens. They will have paid off significant amounts of their mortgage, perhaps already put a child or two through school, and so they can actually start reducing any term coverage that they had at this point in life. But as with many other transitions, this is a time in life when you should look at a transition potentially to permanent insurance. And so I haven't spoken yet about permanent insurance, and it's also referred to as whole life insurance. So just a quick overview and some information on whole life, and then I will answer your question about the spouse. We've already talked through term insurance already in some detail. Permanent life insurance is a pretty powerful tool because it remains in effect as long as you are paying your premium or if your policy is paid off, and it stays essentially in effect for life as long as those conditions are true. So this is a great option for covering things like you see on the bottom of this slide: final expenses, settle your estate, charitable causes, and they provide financial security and flexibility, which I'll talk about in a little later. So a great opportunity to consider a different type of product, typically because it is a little more expensive. The death benefits on these policies tend to be lower, but they play an important role in your financial security and in your protection plan. Now let me talk about the spouse. What's interesting about spouses is that if you look at most American households where one person who is married has life insurance, in the majority of those homes, the other spouse is also insured. What's interesting is that here in AAFMAA, we don't see that. We see primarily service members insured and to a lesser extent, spouses. And so I would encourage people to consider that. And my answer here in this case is that a spouse provides something of value to that household. Even if that spouse is a stay-at-home spouse, in this case you have a working spouse, but if you had to quantify the value of caring for and running a household, whether it's transportation for children, meal preparation, and a whole bunch of other housekeeping, a whole bunch of other similar tasks, if you had to replace that and pay somebody to do that, it would not be an insignificant amount of money. So we see a value and, in fact, a need for spouse coverage in many cases. And if you've never thought about it, I encourage you to do that today, because protecting your spouse is important as it is to protect yourself for all the reasons we've already discussed.
That makes a lot of sense. I know the hardest job I ever had was a stay-at-home mom.
Great. And I mentioned that I wanted to talk whole life in a little bit of detail. I just wanted to put up a detailed slide on that. And this is what I mentioned earlier, that with whole life, it is permanent. It grows cash value, which is an important part of these policies because that cash value is what gives you flexibility. And shown there as two examples are what you can do with that cash value. The other thing with these life insurance policies, and in general, life insurance proceeds, whether it's term or whole life, pass tax-free to the beneficiary. The exception to that is in very large estates, and we would encourage you, if you think you're in that category, to consult with a tax attorney regarding whether that might apply to you. And many of these have an accelerated death benefit, which I'll come to in a little bit.
Okay, so now we're moving along our timeline, and we're getting to the golden years. So now I'm 70 years old. My home is paid off. My wife and I are enjoying our retirement and traveling, and I am blessed with 6 beautiful grandchildren.
Yeah, this is a wonderful stage of life. As you said, these are the golden years. One of the reasons is that they're golden years is that in many of these personas, they have paid off that mortgage, as this person has indicated here. They have put their children through school. And so all of those large burdens are gone. And the question is, well, do I still need insurance? I'm 70 years old. And the answer is that you are still a candidate. And the reason is that everything still applies. You're going to die. There are expenses associated with death, and life insurance can help you cover that. But more importantly, insurance in retirement can help you do some different things, right? If you see on this slide here, it can help you preserve and generate wealth. And I'll explain how that is in just a second. It protects life. It can help sell your estate. You can leave money to charitable causes. And you can get protection through those accelerated death benefits that I mentioned earlier. So let me talk through a little bit of these things. First of all, preserve and generate wealth. With permanent life insurance, which is what is generally more appropriate later in life, when you pay premiums, they grow cash value. And as I've mentioned, you can borrow against that cash value, or you can cash it in. Now, some companies may have penalties or fees for doing that. AAFMAA has neither, so you can borrow against your policy with AAFMAA with no fees or no penalties, and you can cash surrender your policy without fees or penalties. That's the first thing. The second thing is that with these policies, and I'll use the example that we have a policy called Wealth Builder Life Insurance. That is a whole life policy. But not only can you, in this case of this specific type of policy, not only can you cash in your cash value or borrow against it, but if you needed a stream of income, you can annuitize that cash value and receive it over a stream of payments, either to age 100 or to the last surviving spouse, whichever you as a member decide you want. So a pretty powerful tool because it gives you protection in the event of death. You can access your cash as a lump if you need it, through borrowing or through cashing it in, or you can annuitize it and access your cash over a stream of payments. So that is all providing financial flexibility. Now, let me talk about that last bullet. Some policies have an accelerated death benefit. And what these do is these are circumstances recognized by the IRS under which a life insurance company can pay the death benefit, not the cash value, but the actual death benefit of the policy while the person is still alive. And because it's a death benefit, it's treated that way in terms of tax treatment. So we see this most often for two scenarios. One is for terminal illnesses. AAFMAA does not have an accelerated death benefit for terminal illness, but the other one is long-term care. And AAFMAA does have what is called a long-term care settlement option with all of its whole life policies. And as it explains here on slide 17, if you have a whole life policy with AAFMAA and you are certified by a medical professional as requiring long-term care, and you provide that documentation, you could, while you are alive, take 2% of your death benefit for up to 50 months and use it to pay for long-term care expenses. So just another example of the flexibility that these kind of policies can provide much later in life. The other thing I'll say about life insurance policies at this stage and whole life policies is if you go out into the market, you may see universal whole life and variable whole life and all kinds of whole life. Some of those products can be pretty complex. Our philosophy here at AAFMAA is if you don't understand something, you probably should not do it. And so for that reason, we offer very straightforward policies, both term policies. With our term policies, the premium you buy into is a premium you have for the term of that policy. They don't change. The same is true of our whole life policies. The cash value builds on a straightforward mechanism of crediting, and every member should be able to understand generally how their policy works, and that is deliberate. We would never want to offer our members something that they weren't comfortable in terms of understanding that product.
Great. All right. Well, Thank you, Carlos. And we hope that this provides our members with a really useful overview of how different life circumstances affect the type of life insurance coverage you need. But before you leave, I can see that our phones and our emails are going crazy. So we've got some members who have questions.
Okay, I'd be happy to take some questions, but I do want to just walk through this one last slide, and that is for our members and our audience listening today. Again, what I said at the beginning is that what I want you to recognize is that your life insurance needs will change. And so don't become complacent. Every once in a while, take out your policy and look at your coverage and make sure it's right for you. If you have questions about it, call us. We'd be happy to talk to you about it. And what I hope folks have taken away also is that term policies are great products for when you are starting out, when you have very large burdens and you are looking for affordability. Over time, that will change, and towards later stages of life, permanent whole life types of policies can play a very important role in not only protecting your loved ones, but also giving you financial flexibility and preserving and growing wealth. And it's also okay, by the way, to have a blend. We see this all the time. I personally have a blend of insurance. And then lastly, don't forget about your spouse and don't forget about children, right? Because there may be a valid reason to offering them protection as well.
Makes sense. Okay. So we have some questions. If you're going to stay for a little bit, I hope you will, and answer some. First question is, can you explain the cash value for whole life policies? What are the tax implications of cashing out my policy?
Yeah, great question. I already talked a little about cash value, and it applies to whole life permanent type of policies. When an insurance company receives your life insurance premium, we take that premium, and from it, we deduct expenses that are unique to your policy. They could be administrative type of expenses, mortality expenses, which account for the probability of somebody passing away and having to pay out the policy. Sometimes those expenses can be just a straight fee, and so we deduct expenses. And then the balance is credited at whatever the crediting rate. So AAFMAA's crediting rate today is 5.75% annually, and that will remain in effect through 2019. The Board of Directors just approved that. It's a great rate, and it's analogous to, but not exactly like, interest you might receive on a savings account or some other type of financial account. Now, as I mentioned, with most of these policies, you can cash them in or you can borrow against them. With AAFMAA, if you cash in a life insurance policy, there is no penalty, but the gains that you have earned on that cash are taxable as income. So there is a tax implication when you cash it in. In addition, there are some life insurance policies that are considered what the IRS calls modified endowment contracts, or MECs, and those also have tax implications where if you cash those in, if your policy is a MEC, and we would identify it that way for you. If your policy is a MEC, the proceeds are taxable, but loans are also taxable. And if you access the cash before age 59 and a half, you may be subject to an IRS penalty. So be sure you understand the tax implications before taking any action. And if you have a question, please speak with your tax advisor or tax attorney before doing it.
Okay, very good. So the next question, I am grouping a bunch of these into one. How do I know if I have enough or not enough life insurance?
Right. So in addition to determining whether you may need life insurance, the other part of it is, well, how much do I need? And we touched on that a little bit earlier in one of our scenarios, but in general, what you want to do is an assessment, a personal assessment unique to you. And you want to look at what debt and expenses you have or your family may have or incur when you pass away. That's the first part, is what would you owe or your family owe. And then you have to determine what funds or assets you have available to pay those expenses. And any gap between the two is what life insurance should fill in. Now, that's general, but everybody's circumstances are different. So There are great calculators out there. If you do a quick search on the search engine, you'll get dozens, if not hundreds of these. And that includes AAFMAA. If you go onto AAFMAA's website, in our tools and resources areas, we have a life insurance calculator that walks you through this in a little bit of detail and gives you an idea of what coverage you might need. And it accounts for things like college today, college down the line, your mortgage, and a few other things. So if you haven't done it in a while or not at all, I highly encourage you to do that and see where you are in terms of your coverage and potential gaps.
Very good. So we have a question written in. My wife and I are getting divorced. We both have life insurance policies on each other. What happens to these policies?
Yeah, divorce is a scenario that we do come across at AAFMAA. And what is very important when a policy owner is going through a divorce is that the laws differ by state. And specifically, in some states, a beneficiary designation is nullified by divorce. So the law says that if you are divorced and your spouse is your beneficiary, that designation is nullified. And this is very important because if you're in a circumstance where you still want your former spouse to receive the proceeds of your policy, you should go back and update your designation to say former spouse. Because if it's received by the insurance company as spouse, and the law of that state nullifies a spouse beneficiary designation, that spouse would not receive the proceeds. So it's incredibly important to make sure that if you are, if that's your intent, that you specifically state it. Secondly, it's always good to periodically review beneficiaries, and don't just leave it for the insurance company to guess. So if you don't want that spouse to be the beneficiary, then designate who you want it to be and make sure it does not happen by accident. So a very important question, and one that we should pay close attention to if this applies to you. The last thing I'll say about divorce is some divorce decrees actually require or mandate that a spouse maintain coverage on the other spouse or keep that spouse a beneficiary. And so if that applies, you should comply with that court order. And while AAFMAA will not get involved in the enforcement of legal actions, we do follow the legal standards that apply in that case.
So I'm going to do one more question. We're going to take one more question. Sure. Here it is. My wife and I are in our 80s. My wife has severe Alzheimer's. What do I need to do with regards to life insurance?
This is a very complex case because it deals with incapacitation of somebody who may otherwise take action. And so in cases like these, we recommend, number one, that you speak with an advisor, either a legal advisor or a tax advisor or a financial advisor. That's the first thing, because everybody's circumstances are different. And we cannot give tax, financial, or legal advice. But what I would say is that, in general, if a person is incapacitated, actions that relate to policy ownership or death claims would typically be coordinated through or paid through somebody like a guardian, a conservator, or a trustee. So what's important for you to do in these circumstances is to make sure that your insurance company, if it's AAFMAA, has the required legal documentation so that there's no ambiguity regarding who can act on that person's behalf. That's the most important thing you can do in these circumstances. These documents can include things like trust documents, court orders, and other similar legal documents. But more importantly, what I would encourage this member to do is to act now. In other words, act before incapacity becomes an issue, if that's possible, right? Review your beneficiary designations today. Review your ownership today. And if they're not what you want them to be, then change them while you have time, so that you don't burden somebody in the future with having to wade through legally ambiguous waters.
Okay. Very good. So thank you, Carlos. And I want to thank all of our listeners. We're about out of time. We've gotten a lot of great information, and we hope you found this webinar helpful. We encourage questions and feedback.
Yeah, Natalie, thanks for doing this. This was a great idea. I'm glad you came up with it. I've enjoyed the conversation. I would just like to conclude by encouraging our members to go back and do some homework, review your policies, review your designations. If you have any questions, we're always happy to speak with our members. We've put some contact information here. We also have contact information on our website, www.afma.com. Check us out and reach out to us if you need to. And I also want to thank all of our members for being a great part of who we are here at AAFMAA. We appreciate all that you do and are grateful for your membership. So with that, I'm going to turn it over to Kathleen, who has some concluding announcements.
I do. Thank you, Carlos and Natalie. That was a great presentation. So we'll go ahead and break here for now, but you can reach out to us whenever you need to. Please don't hesitate to ask for help. It is every day for a military community, and it's our pleasure. You can always register for future webinars and review past webinars at afma.com/webinars. If you found this information useful, we encourage you to please share it with your friends and family. Our membership grows stronger every year because you introduce those in your military community to AAFMAA. Thank you again to everyone listening. We look forward to our next opportunity to assist